Ja, ich freue mich nach vielen Monaten wieder auf einen ganz besonderen Gast, Dan Niles, heute nicht aus Seattle, sondern aus dem wunderschönen Florida. Dan, hi.
Hey Marcus, how are you?
Gründer von Niles Investment Management, ein sehr erfolgreicher Hedgefonds-Manager, jemand, der schon Ende der 90er Jahre die Tech-Bubble, das Platzen der Tech-Bubble richtig vorhergesagt hat. Und Dan, you're no longer in Seattle, you're now in beautiful Florida. Welcome in the show.
Thank you. Thanks for having me on.
So early this year, one of your biggest positions among your top five picks was cash. And cash indeed outperformed this year, looking specifically at the magnificent seven stocks. What would need to happen for you to take a bit more of an aggressive approach?
Well, I mean, I think it's positioning and how the macro evolves. And so when I came into the year, I said, look, if everything goes perfectly and earnings are up 10% and stock market multiples, which are high, don't contract, you could have the S&P up 10%. But the other scenario is if things don't go perfectly, you have some problems with growth or inflation that has to act. Because don't forget, President Trump's policies, they have multiple impacts, right? They can be inflationary as well as pro-growth, and they can also slow the economy depending on how they're put on or taken off. And so if you have that kind of scenario, you could have easily multiples contract 20% or so, and the market could be down 20% for the year if that plays out. And so that's why cash was one of my top five picks for the year. I think as the year has evolved, one thing that's become increasingly clear, and I'm sure we'll get into it, is other regions of the world, despite all of this angst over tariffs, are actually doing quite well relative to the US. And so I don't think this is all about tariffs. I think this is more about investors realizing that tech stocks in the US that were driving the markets, as numbers are coming down, other areas across the world look more interesting. And so that's kind of where I'm looking more to deploy capital, where valuations are less. And quite honestly, countries like Germany, for example, where you're from, has more room to maneuver in terms of stimulus because they didn't do as much over the last couple of years.
Yeah, Wall Street is for sure no longer the only game in town. There's a lot more competition now globally looking at the stock markets. I mean, your range early this year was huge, 10% up or 20% down by the end of the year. And I loved your quote about Darwin. It is not the strongest species that survives, but the one that is most willing to adapt. Now we already have the beginning of March. Now looking at this huge range you gave early this year, how is this range shifting when you look at the macro developments and the correction we're witnessing at the moment?
Yeah, I mean, obviously the up 10% becomes less likely as you kind of see how things are going. I mean, in particular, I think I came into this year thinking we would have an AI digestion phase by the middle of the year. And the more data that's come out with the companies that have reported, if you think about it, out of the Magnificent Seven, six of them had their March quarter estimates cut when they reported the December quarter estimates. NVIDIA, which is the poster child for the AI trade, was down 8.5% the next day after reporting earnings because their gross margin guidance was weak. So you've got an earnings problem. And so in that scenario, and clearly the stock market didn't like it as a whole. And so you kind of hope that maybe, well, you can have a problem in the AI portion of the market, but the rest of the market can be fine as investors rotate into other areas. And which is happening, by the way, because if you look at the equal weighted NASDAQ or the equal NASDAQ 100 or the equal weighted S&P, they're actually up for the year versus the Magnificent Seven that are down about 10% or so. And so that is to some degree happening, but the overall market has been somewhat weak. And so that was also a wild card. And quite honestly, over the last 48 hours, we've been hearing about TSMC cutting capacity additions for their chip on wafer scale packaging, which is basically going to package NVIDIA chips. And so and that, by the way, would be the first time in probably 2 years we've heard of any downward revisions in packaging demand. When you start to hear things like that, you go, okay, well, obviously some of the weakness we're seeing in CapEx budgets from the big hyperscalers, when you look at it on a sequential basis, that's starting to show up potentially in maybe what NVIDIA is seeing. Because you look at the forecasts and you've got NVIDIA growing revenues 10 to 11%, which is what the street has it. NVIDIA doesn't guide out more than one quarter, but the street has NVIDIA revenues growing 10 to 11% for the next 4 quarters in a row. But you look at the customers' CapEx forecasts, and even though they look strong year over year, they're going from up 15% year over year, up 15% sequential growth for the last 4 quarters to that slows to like 5 for the next 2. It's hard to match those up. So I think
Dan,
it's a big problem.
Dan, elaborate on that a bit more, because I think that a lot of investors don't recognize that issue. Just looking at the CapEx spend from Amazon, from Google, from Microsoft, it all sounds like tremendous growth. And on an absolute basis, the number is higher than last year. You, however, point out that on a sequential basis, this looks quite different. So how are we to look at these numbers?
Well, I mean, you can't outgrow your customers forever. And so in math, if you actually grind through that, it's pretty simple. And I've written on this before, where let's take Oracle, for example, because out of all the big hyperscalers, they probably have the most aggressive numbers when you look at them on the surface. So if you look at Oracle, and don't forget, Oracle's involved in the Stargate initiative with SoftBank and OpenAI. Oracle said their CapEx is going to double in their fiscal year. And so you go, wow, up 100%, that's huge. If you then actually sit down and do the math on it, you go, well, that implies about, I think, $13.7 billion in revenues for this fiscal year. But their fiscal year ends in May. They've already done 6 months of that. And so you figure out, okay, well, that means they only have $7.5 billion they need to spend over the last 6 months of the year, of their fiscal year. Mm-hmm. But they spent $4 billion in the most recent quarter. So even though it looks like their spending is up 100% year over year, on a sequential basis, their spending is actually going down. And so that's just one example of many where if you look at, the other companies, it's a similar situation where you say, oh my God, the spending is up, 50% year over year. But then you look at it on a sequential basis. Microsoft's a good example because their fiscal year ends in June. And you go, wow, the spending is basically slowing to flat. And so even though these numbers are up 50 to 100% year over year, on a sequential basis, they're, more flattish. But you look at NVIDIA's numbers and you say, well, wait a minute, then how are they supposed to grow revenues at 10 to 11% for the next 4 quarters in a row? And so that's where the disconnect starts to come in. The bigger issue, quite honestly, Marcus, is not so much even that. It's, are you generating revenues from all of this money you're spending? And when you've got Amazon, Microsoft, and Google, which are the 3 biggest hyperscalers, all having numbers go down for the March quarter after they reported the December quarter, you've got a problem because the ROI just isn't there. And by the way, this is not the first quarter this has happened. It started happening back in the June quarter of last year, which is when I started talking about the fact that I thought we would have an AI CapEx digestion phase. Back when they were all 3 of those guys reported the June quarter of last year, they had the September numbers come down as well. So this has been going on for a while, but a lot of times it takes a while to catch up because, after you've seen explosive growth for a couple of years, it's going to take you more than 1 quarter or 2 quarters to go, you know what, maybe we can spend a little bit less going forward to match revenue generation with how much we're spending on CapEx.
Now, early on in 2025, you already stayed away from the Magnificent Seven. We've now witnessed quite a bit of a correction in many of those titles. Are we at a point where Dan becomes a bit more optimistic in regarding a technical bounce, or is your fundamental concern still in place?
Well, obviously, on a short-term basis, you can get a nice bounce, but you have to look at things on a long-term basis, I think. And so, can the Magnificent Seven go up 5% over the course of the next, week or so, or a couple of weeks? Yeah, that's obviously possible, just because things have gotten oversold. And if you get some, thing around tariffs where people feel better and they feel better about growth, obviously that can happen. But the bigger issue is, are the customers generating revenues from all this spending? The answer is no, which that is the answer. They're not getting incremental revenue growth. I mean, you can look at even on the software level, where agentic AI was the next phase that was supposed to benefit from all these lowered hardware costs. And CRM, which is Salesforce, which is kind of the poster child for that, they missed the revenues for the quarter. They guided below the street for the next quarter. You're not even seeing it at the software layer. So you have to, I think, go through these one by one. And I've sort of joked, it's not the Magnificent Seven anymore, it's the Magnificent One. Because other than Facebook, every other one of those names is down for the year. And they're down big, right? And so I think you have to go through them one by one. And I can if you would like, but I think each one's very different in terms of the forces that are driving them. Why don't think about it? But I think
why don't we, Dan? Why don't we take the opportunity and maybe dive into one or two names in this environment among the Magnificent Seven, the one where you think there has the bigger issues, and maybe also into Meta, because also Meta's corrected and came down quite a bit in the last couple of weeks.
Sure. Well, I'll go through each one pretty quickly, maybe. Okay. So with Meta, the thing is that I firmly believe TikTok will end up in U.S. hands to some degree. And at a high-level perspective, I'm sure there's some people that, don't necessarily think that'll happen. If that does occur, that's obviously not the greatest thing for a Meta. So that's something you need to remember. But on a longer-term basis, they're using AI the best out of all the big companies, in that if you look at last year, they were investing a lot, but the revenues and EPS kept going up. And so Meta's been a top 5 pick of mine for the last 2 years. It wasn't this year because of some of the other concerns I had. But if you're going to try to pick one name that's doing a great job of getting a return on that investment, it would be those guys. Google is interesting just because, and I've not liked this name for a while, but it looks like the numbers have come down enough and the valuation is low enough where you go, and some of the changes they're making internally, where it looks like they're going to get a lot more aggressive on their AI offerings versus just trying to put out politically correct results where you're actually returning accurate results. If they do that, they have more data to train their models than probably anybody, right? With their ability to get all those search terms, et cetera, and to put it into their model. So that one's kind of interesting from that perspective.
One question regarding Google. There's a lot of debate that AI might harm the search business tremendously, and that's been very important for Google, of course. At the same time, you also see Waymo getting a lot more traction, also in cooperation with Uber. If you look at Google and regarding the rise of AI and the effects on search and the rise of Waymo and robotaxis, what do you focus on?
Marcus, you jumped in. Those were the exact topics I was going to bring up on the negative side, and you're 100% right. Those are the things you have to be concerned about, and that's why the stock has tremendously struggled. And then in addition to that, you have to look at the fact that at some point in the future, I don't think they'll be able to pay to be the default search engine on Apple's home screen. And so those are all negatives you need to take into account, which is why that name is, I think, particularly tricky. And Waymo is just not going to move the needle on their results anytime soon. So it may help the multiple, but it's not going to help with the actual revenue generation or EPS at any point, just because the search business is so enormous. So that's why Google's a tricky one, in that valuation's nice, it's oversold, but again, it's probably does nothing more than bounce. With Apple, obviously, just sort of rounding it out, they've got the tariff risk. Potentially, if things escalate with China that you have to deal with. The good news is numbers were so bad that maybe on the margin, put together a good quarter somewhere in here. But Apple Intelligence is a non-starter. It's not particularly that compelling. And the valuation is ridiculously high, obviously. We've already touched base on NVIDIA. And I think if you go to Tesla, it's in a world of its own, obviously. Last year was the first year in over a decade where deliveries were down year over year. So it's hard to be bullish on that with the valuation it had. Obviously, sentiment will drive the stock up or down. It rallied, 60, 70% after Donald Trump got elected. And obviously he's given back a ton of that. But, and then Microsoft is probably the most interesting of the bunch, because if you go and listen to the podcast the CEO has done, the most interesting thing was recently he said, look, I'm looking forward to being a renter of capacity come 2027 because of all this investment going on that's going to drive compute costs down a bunch. So that certainly doesn't sound bullish. Now, the good news is if they can just rent capacity versus spending all this money, their free cash flow will dramatically improve. But you got to remember, these guys have seen the forward numbers get cut after they've reported each of the last 3 quarters, and they had an exclusive relationship with OpenAI, which produced ChatGPT. So the fact that they're seeing no return on that investment on a top-line basis for the last 9 months, that tells you something. And so that's what makes that stock tough to deal with. And then Amazon, obviously, they're impacted by, do we get a recession or not? Because obviously that'll impact retail demand. So that's why all of these names are very tricky to deal with. And I was worried about all of this, which is why none of them were in my top 5 picks list coming into this year, which is the first time in years that I can think of. I haven't had one of them in there.
Now, I play a bit of devil's advocate. I remember the first time we met in beautiful Seattle in your backyard with the eagles flying through the air. You mentioned one of the reasons for being bullish about Meta is the fact that Zuckerberg can reduce the capex at any time he wishes and increase profitability. Now, couldn't I make the same argument that if Microsoft, Amazon, or Google realizes that these tremendous capex investments might not actually pay off or monetize the way that they were hoping for, why not reduce the capex, increase margin, and have much higher profitability?
That could very well happen, but the question you have to ask yourself is, what portion of the multiple for these companies is related to people's optimism on AI? And if you take that optimism away, you're going to have a big problem with the stock prices because the multiples are high, right? Because a lot of these names are trading at, close to 30 times PE. The market's, more in the low 20s. And so you could have a massive correction in the multiples if that occurred. And think about it in the sense of 01, 02, right? Because Amazon's revenues doubled during 2001 and 2 over that 2-year period of time, and the stock went down 95% from peak to trough. It's not like they had a problem with growth, but people's perception of, is it this massive growth up and to the right every single quarter, that changed quite a bit. And so that's why I think some of this is, you said it earlier, right? I had that quote about Darwin of it's not the most intelligent or strongest survives, the one most adaptable to change. And so that's why you kind of need to look at what these companies say, but then more importantly, arguably, how investors react to that to figure out where their heads are at. Because until it occurs, you just don't know. And I think that's the key, because even though Microsoft has been talking in such a way, right, the CEO had that podcast, it's not like the stock rallied a lot off of it. I think people were looking at it saying, there must be an issue on the demand side. Otherwise, he wouldn't be so excited about renting capacity instead of building it, which is what he's been doing for the last couple of years. So I think that tells you something right there.
So what I'm hearing from you, if I get this correct, is that the monetization aspect of AI will probably take a bit longer, or there's too much hype built into the expectations of monetization. And maybe you can elaborate a bit on that. And also why, in your opinion, the Salesforce numbers were so important looking forward.
Well, I think maybe for your viewers who watch this, ask yourself, if you're a viewer, how often you're using an AI product on either your smartphone or your PC.
You know,
if you're not,
you know, I'm not real, right? I'm AI coach.
Well, I'm not either, so I got you there too. but if you're not as a consumer, you should ask yourself why you're so bullish on AI. Because at the end of the day, if you think about the internet, for those of you who were around to see it kind of blossom in the late 90s, you had things like Amazon and other stuff that people started to use, and so it made sense. Now, as I said earlier, it didn't mean that NASDAQ didn't go down 78% from peak to trough over 2 years, as we figured out the internet was doubling every year, not every 3 months. But the point being is, until you get a killer app for the consumer, right? And it's whether it's on the smartphone or the PC, until you get that, it's going to be hard to monetize all of this CapEx. Now, the reason I bring up Salesforce is the bull theory is, okay, well, even if I don't end up with the hardware layer continuing to grow at that torrid pace, the software companies are going to benefit because lowered hardware costs are going to help them drive revenues. And so think of who really benefited from that build out in 01, 02, right? Cisco was the most valuable company in the world in 2000. It's never gotten back to those levels. Ciena's never gotten back to those levels. They provided optical equipment, right? Akamai, are we serving a lot of videos on this thing called the internet? Absolutely. Akamai is nowhere near where they were in 2000. So, but you have services sitting on top of it. Social media, absolutely. Search, absolutely. E-commerce, absolutely. And so all these companies have benefited from those lower hardware costs. That was supposed to be the next leg, and CRM, Salesforce, was the poster child for that, and they missed revenues, and the forward numbers for revenues came down as well, which is why even if you're not getting a consumer killer app, you would hope you're seeing an enterprise killer app, and you're not seeing that either from the poster child of supposedly the one that benefits from this. So you're not even getting that bridge in business while you wait for a consumer killer app. There doesn't seem to be a business killer app either.
So generally speaking, other than a technical bounce that could be possible, the fundamental concerns regarding the Magnificent Seven seem to stay in place. Dan, the introduction of DeepSeek in the inauguration week of Donald Trump, how much did that change the story? And OpenAI is now also thinking about going open source. Who are the benefactors of this trend, and who are the losers in this environment?
Well, I think DeepSeek showed you that, necessity is the mother of invention. Did they train it for as little as they said? Absolutely not. Nobody believed that. But did they introduce innovations that really do cut the training cost by quite a bit? Things they did to help with memory consumption and usage, etc. They absolutely did. So they bent the curve, as you call it, in terms of, well, how much hardware do you need to produce a certain amount of output, AI output? And so that certainly showed that, if you adopt these interesting techniques that they use, because don't forget, DeepSeek stuff was open source too. Mm-hmm. And Meta's going to use it in their models, which Meta before this was considered, their Llama models was considered the best open source AI software out there. And, they're going to incorporate those things into their Llama models going forward. Because don't forget, ChatGPT was also built on top of the innovations Google did on transformers. They were the first one. And so all of these innovations build one on top of the other. And so DeepSeek really did change what people thought you needed to spend. And so that's a big deal. And that's why I'm looking, a year ago, I had KWeb as one of my top 5 picks coming into last year. Obviously, I was too early. It was only up 8% last year. But you look at it this year, and it's up about 17% or so as of the close yesterday. And you're seeing people look at that and saying, wow, a lot of these AI-related companies in China are trading at half the valuations of these US companies, and they've been given up for dead for good reason, right? The Chinese government has gone against these companies really since Alibaba's Ant Financial IPO was blocked by the Chinese government. But just recently, Xi Jinping embraced Jack Ma at this meeting in terms of, we need these companies to do really well. And so they're kind of back into the fold. So maybe that does mark a change in sentiment. And it's not just the US that's going to do well in AI. You've got other regions of the world that can do well also.
It's going to be interesting to see Meta's launch of the AI app that they just announced a couple of days ago. But sticking with China, I mean, you in January recommended China Internet ETF, the KWEB ETF. It's up 17% year to date. The Magnificent Seven are down 10% year to date. What does it tell you about sentiment regarding American tech companies in regards to global tech companies?
Well, I think as we said earlier, right, Canada is barely down. Mexico is up 7%. Eurozone's up 14%. Emerging markets are up 3%, and the Magnificent Seven are down 10%. And so I think that tells you a lot about the fact that when stocks are going straight up, it's kind of funny, right? Investors will just forget everything related to fundamentals because the charts look good. And greed is trumping fear, right? Then when you have something like DeepSeek happen, people then start to go, oh, well, maybe I do need to pay attention to some of these data points that don't sound so bullish, like Salesforce or TSMC with their packaging or something else. And maybe valuations, like people don't care about valuations when stocks are going up. But when they start to go down, that gives you your margin of safety. Like, well, how much of a premium is it trading to its historicals? I mean, that's one of the things I brought up coming into this year, where looking at where CPI is, let's say it's between 2.5% to 3%. The trailing PE for the S&P 500 when CPI has been in that range has been 19 times trailing. You entered this year at 25 times trailing. You had no valuation support if anything went wrong. So that's one of the reasons why I thought the market could be down 20% this year, right? You end up with a valuation contraction, and I thought that could be led by the AI stocks. And unfortunately, for right now, that seems to be the case. And so unless something changes, and you brought up a great point with Meta, will Meta introduce something that does turn out to be the killer app? Something that consumers go, oh, this thing is really useful. Like it can book a hotel room for me, rent a car, buy stuff for me online, whatever it is. Maybe that's the thing that'll work, because over 3 billion people on the planet use one of their products. And so maybe that's it. I mean, we'll have to wait and see, but Meta has killed it so far in terms of all the tech companies, in terms of really driving profits and revenues with AI. And so we'll see how that turns out, because Zuckerberg's definitely all in on that. And so far, he's generating revenues and profits, even though he's gone all in on AI. Unlike with the metaverse way back, a few years ago when you were in Seattle watching the Eagles fly behind us as we were doing the interview.
Let's touch base quickly on the macro environment. You made a very interesting point saying that tariffs are not really the key issue. And indeed, you have the European markets taking off. You have the Canadian and Mexican market hanging in quite well, despite these tariffs that were announced or at least threatened. How do you explain the fact that those global markets don't seem to be affected by the tariffs, and vice versa? Is Donald Trump, is the administration harming an environment in the United States more than the global environment, looking at the growth expectations here in the US coming down now?
Yeah, I mean, I think the thing you have to remember is that if you step back, there are trade imbalances. Everything Donald Trump is complaining about is true, but it has been going on for a while. And to fix some of these things that are issues in his mind. And there's some stuff I agree with, there's some stuff I don't. But to fix these issues, and the big one to me is the debt. As we saw, I mean, I worked at Lehman Brothers back in the day. And people were like, oh, there's no problem with the housing market, right? You may remember the Fed's famous saying back then of, we think the subprime crisis is well contained. It turned out it wasn't. Yeah. And so ultimately the debt's going to kill you. Now, you don't know when that is. And so I think his laser focus on trying to solve the debt issue in the US, and we can argue about the methods he's using to try to do it, but it is absolutely, in my mind, the right focus, because at some point that's going to be a huge time bomb for the US. And so I think him going after that makes sense. The tariff stuff, the reason why I don't believe it's ultimately going to be a big issue is because the US consumer, like everybody talks about wanting access to the Chinese consumer. The US consumer by itself is 1/6 of global GDP. 1/6. Europe doesn't want to lose access to the US consumer, neither does China or Mexico or Canada. And by the way, all of those countries export more to the US than we buy from them, by far. Europe is the closest, where we consume about, we send about 17% of our exports to Europe. They send about 20% to us. But having said that, we're also spending a lot more on defense than Europe is. And obviously, Russia's right next door to you. And luckily, we have a big ocean between us. So there's certain other things that, because there's spending imbalances, if you can get them more into line, the US can spend that money on something else if Europe's spending more on defense. So, the problem is you're not going to go through a rebalancing of who's spending money on defense, what the trade, which markets are open, try to have everybody have the same tariffs back and forth, or no tariffs would be great to settle on, right? Where everybody decides, you know what, yeah, we should just remove all the tariffs and let free markets take over to some degree. To rebalance that, it's the old saying in the US where to make an omelet, you got to break a few eggs. And unfortunately, we're in the breaking eggs phase right now. And when you're rebalancing stuff, there's always going to be some pain. But, the funny thing to me, Marcus, is I look at it and go, is the S&P down 1% that big of a deal? Is NASDAQ down 5% that big of a deal?
Well,
it's nothing.
I'm having a bit of an issue with that argument because, yes, on the index level, it's a few percentage points. But if you lift the carpet and you look at individual stocks, the correction is a lot more intense, especially in the momentum area, and the mixture between a fear of slowing growth and a momentum turnaround and cooling off and valuations coming down did create quite a bit of damage. So maybe one question.
Well, that's a different problem. That's a risk management problem. If you were that overweight in the momentum sector, then you weren't managing your risk well.
Good point.
Because you can't sort of say, I mean, I always had a problem with this whole Magnificent Seven argument, because when you have that small a group of stocks driving the entire market, ultimately that's not going to end well. And I saw that in 01, 02, and that was not pleasant. So this was going to happen, and some of this is it's a risk management problem. And obviously the Magnificent Seven are down over 20% from their peaks. But if you were massively overweight this stuff,
like everybody and their neighbor,
that's your issue. You had plenty of warning signs. As I said, you can go back and read some of what I wrote. When these companies reported their June quarters, I brought up, look, this is a problem. Because when you've got the three biggest guys in cloud all having their forward revenue estimates for September get cut when they're reporting in June, it tells you that this big ramp we're seeing off of all of this AI optimism, that's petering out. And by the way, if you go back and you look at NVIDIA stock, that's kind of where it peaked out. Yeah, it got to a new high earlier this year for a brief moment, but the thing's been going sideways ever since. So this is a risk management problem, and saying, okay, I don't care what multiple I pay for these stocks, and I'm just going to ignore Germany, I'm going to ignore the European Union, I'm going to ignore China, where valuations are a lot better.
we are seeing quite a few economic numbers disappointing. The GDP Now indicator is now dropped to negative 2.8% for Q1. You have the ISM industrial manufacturing below estimates, also regarding new orders. And you see a lot of earnings coming out also on the consumer end with forward guidance coming down. How big of a risk do you think is the slowdown in the US economy, also for the stock market? And do you see the risk of a stagflation playing out, with inflation actually rising and the economy growing slower?
Yeah, I mean, that was one of the big concerns I had coming into this year, because people always, they forget certain things. And so they kind of forgot that there was an Olympics last year. We had the most expensive election in history last year. And so all the money that was spent on those things on the advertising side, which, affects the internet companies, we're not going to get it this year. And so all of that goes away. Small things like not having leap year in the March quarter. You've seen several consumer companies talk about that. I mean, that's only 1%, but when you've got valuations as high as they are, and a Walmart going straight up every day and Target going straight up every day, and then all of a sudden the numbers get cut, you've got an issue. And so, or, Easter shifting from the end of March to April 20th, that again shoves out demand from the Q1 into Q2. So you've got all these different things, I think, going on at the same time. But am I worried about a recession? Right now, the answer is absolutely not. And there's one reason for that, is that when you've got unemployment in the US running close to 4%, it is hard to get that concerned about a recession. And it's the same reason why I thought inflation was not transitory in 2021, which is at that point you had twice as many job openings as people unemployed. And I'm like, there's no chance that inflation is transitory in that environment. And right now, you actually still have more job openings than people unemployed by a small number. But normally, even in a healthy economy, you've got 10% more people unemployed than job openings. So there is no question there's a growth scare, and there should be, right? Because uncertainty, people hate that. And I also do think, because people were so worried about tariffs that Donald Trump might put in, there was a pull forward in demand, which nobody wants to talk about, where people were buying things, whether it's other countries were buying GPUs or whatever you want to pick. US consumers maybe were buying a little bit ahead, afraid of prices going up. And I think there's some payback to that, because unfortunately, people want access to the US consumer, because the US consumer loves taking out debt and buying stuff they can't afford sometimes. And I think some of that happened because when you've got stock prices going up, home prices that have been going up since COVID, and all of these, and unemployment at 4%, you feel absolutely bulletproof as a consumer. You introduce a little bit of uncertainty, and then things are going to get a lot more challenging. And you combine that with extremely high valuations relative to where inflation is, and that's why I thought the market could be down 20% this year. So, I think the key is, act like Charles Darwin and be adaptable to change, because this volatility is not over. I think it's going to be going on for.
It's not going to go away, but you do not see a recession on the horizon at this point. What about inflation? You said early this year that there's a 50% chance of the Fed actually increasing rates in 2025. Do you still stick to that?
Yeah, I still stick to it, because right now it's funny because you've got people saying, "Oh, the Fed's going to have to cut. There's a Fed put," and I'm like, I don't believe this Fed has been particularly good, right? When you think inflation's transitory, you end up with the worst inflation in 40 years. I think that pretty much says it all. So, but I think they're smart enough to go, the 1970s, the big mistake was cutting way too early, and then inflation really was a problem. And don't forget, 30 days ago, we were wondering whether the Fed would have to raise. The economy in general, unless you have some big exogenous shock, right, like COVID, it doesn't turn on a dime. So all those factors that had unemployment at 4%, had GDP growing at 2% and change, they're kind of still there. And I the crux to this is, if you were going to tell me, hey, Dan, these tariffs are going to be on for the next year, then yes, we're going to get a recession. I think they're going to get sorted out because, when you've got Mexico and Canada exporting 80%, 80 of their exports go to the U.S., that's going to get solved very quickly. Europe, much bigger issue. China, much bigger issue. But nobody wants to be in a tariff war, including Donald Trump. And don't forget, Donald Trump really focuses on the stock market. And so he doesn't want that going down that much either. I don't worry about a Fed put. I think, you could very easily have a Trump put. You're just trying to figure out what level that might be. So I just don't see the recession. But what I am focusing on is investing in value stocks, mid-cap stocks, things that benefit from some of the policies the administration is trying to put into place. And so that's where I'm focused, and not the Magnificent Seven.
So your top picks for 2025 from January: Cisco, Atran, China Internet ETF, iShares S&P Midcap ETF, and cash. That pretty much stays in place, doesn't it?
Yeah, and you take advantage of things like yesterday when the market was getting crushed, and I bought a few things that I was like, oh, you know what, I didn't like it at that price, but at this price, yeah, I think people are getting a little negative. You can tactically have some positions, but I think investors need to have good risk management. To the question you brought up earlier, right, about, as you rightly put it, there's a lot of damage underneath the surface, right? And some people are feeling a lot of pain because they were overweight a lot of these stocks. But I think you need to kind of take a step back, take a deep breath, and go, well, I made a lot of money over the last 2 years owning these names. So if I give some of it back, it's not that big of a deal, but I just need to manage my risk better. And I think those stocks that I picked coming into the year were predicated on the fact that if the market's down 20%, hopefully they're going to outperform because valuations are good. Administration policies would hopefully help them, and other specific things to each of those names that would help them do better. And so far, knock on wood, in a tough tape to start the year, that's certainly been the case. And we'll have to see, but I think you got to stay adaptable. And it's a new challenge, right?
Risk management is key, and once again, losing $1,000 creates double amount of pain than the enjoyment of making $1,000. So psychology is here again. Dan, I really appreciate the time with you today. It's been a pleasure. Thank you so much for coming in, and much success for the remainder of the year.